All right. Hey, everyone. Thank you so much for spending your evening here with us. We only have like slightly over half an hour for this, so I don't want to talk too much. So today's topic is on building a bank from scratch. So from getting reach to getting rich, when we talk about digital banks, it is known that a majority of them have trouble, reaching a break-even point, let alone turn a profit. So today we're going to look at the path to profitability and how do we build a bank of the future. And I'm going to let our guests introduce themselves.
Hi, my name is Simon Loong. I'm the founder and group CEO of WeLab.
Hi, my name is Sheyantha. I'm the group CEO of Boost.
Hi, I'm Pranav. Seth. I'm the Chief Digital Officer for Techcombank in Vietnam.
Hi, my name is Dwai. I'm the CEO for Trust Bank Singapore.
All right, so we're going to first obviously talk about something that's taken up most of the last 3 years, and that is the pandemic. And right now we have to grapple with the macroeconomic situation as well. How has that impacted the demand for digital banking? I mean, more functions moved online as we saw during the pandemic.
I think we're at a very interesting interest rate and macroeconomic environment right now. We were just joking with my COO the other day, right? The last time we're at this like 4% interest rate, banks are lending out at 12%. When it became 0, banks lend out at 8. But now we're back at 4, we're still lending out at 8%. So we have not really adjusted yet. I think that's something that we need to grapple with, right? I think banks need to move faster to a high interest rate. In terms specifically on digital banks, a lot of digital banks traditionally use high interest rate to attract deposits as an initial customer acquisition strategy. Now, when they were offering 8%, 8% versus 0%, very attractive. 8% versus 4%, not as attractive anymore. I think that's another one. Now, but I think another thing about high interest rate environment, right? You have to understand high interest rate actually help traditional banks more than digital banks because they have a larger deposit base. They can reprice the existing deposits. So it will be challenging for digital bank starting to build a deposit base. I think the last but not least, right, the interest rate were increased with the objective to slow down the economy. And if you look at the valuation of tech companies, including digital banks, right, it is based on a extrapolation of growth. Fast growth equals to faster future growth. But then when the future growth actually going to taper, I think if you do discounted cash flow, you see that tech companies, as you have seen right now, a lot of large tech companies' valuation has dropped 30 to 70%, right? Digital banks will suffer when they go and fundraise, when they do not deliver profitability and growth trajectory. But having said that, I think when wages, rent, everything is getting more expensive, my bet would still be on an efficient player. An efficient player means you use everything digitally, no branches, fully automated. I think in the long run, digital banks will win, but you just need to probably endure through these, let's say, 1 to 2 years.
And digital penetration, internet penetration in Asia is high, so that means there is space for digital banks. I want to talk next about the path to profitability. Simon Kucher's analysis of 25 of the largest digital banks found that only 2 have achieved profitability. In fact, a majority of them earned less than $30 in annual revenues per customer. So it is crucial to get the value proposition right. And Pranav, maybe you want to start with this one. How do we get there? What should be the approach?
Yeah, sure. First of all, let me try to debunk the digital versus the traditional bank because I'm confused whether I'm a digital bank or a traditional bank, right? I think we are a 29-year-old bank, but 50% of our new acquisition comes digitally. Over the next 2 years, we are looking to double our customer base from 10 million to 20 million. And with a very clear path to profitability. I don't think I have the valuation leeway, and which is now disappearing for the pure standalone digital banks as well, right, to take a very infinite path to profitability. The profitability needs to happen in a very feasible path. So I think whether you're a traditional bank driving growth by digital or a pure standalone digital bank, I think it comes down to basics, 3 basics, right? One is the cost of acquisition. The second as Simon mentioned, you've got to be an extremely lean, digital-only led, play. I mean, you can still have humans to cross-sell some things, right? That's the second point. And the third point is around how do you maximize the value from the customers mostly digitally, and then, if need be, through the physical channels. So as we think about profitability, CPA, driving down CPA, if you are driving it digitally, the only model that I have seen work is partnerships, right? So I think, for example, for us, we are working with the largest, the grocery stores in Vietnam and other partners to drive the acquisition digitally with a partnership with them to keep the CPA low and not compromise that for the sake of growth, right? So keep the CPA low, below $5 or something, and I think you shall be good. Second comes, I think, what I mentioned about efficiency. Whether you're a new bank or a traditional bank, I think you've got to clean up your entire product processes. When I was running my previous role, right, where a youth-focused bank out of Singapore, my biggest issue was around card authorization cost, right? So you never know where you can keep everything lean, but there might be some little elements of cost that keep on peaking up, which do not scale digitally, right? Which increase by volumes. As a digital player, you need to be absolutely critical which are the ones which are going to scale well digitally and the ones which not, and go after those costs. The second. Third, I think, is the power of data, right? If you are a digital bank, you better be leveraging data as your friend. You don't have people to make friends with the customers, so your only friend is data. And question now is that how well are you personalizing your conversations with the customers, how well you are using your data to lend to those customers, which traditional banks have failed to do so very well, even exploiting their own data, right? So as we think about digital banking, you need to be absolutely sure you're extracting the last value of every ounce of your data and the ecosystem data.
Shay and Dwight, do you have anything you'd like to add?
Thank you. I think in some way we have an unfair advantage. We already know what has worked and what has not. Now, digital banks have taken off in many parts of the world for the last 8-10 years. And as you know, that initially it was all about experience, it was all about creating a seamless onboarding, and sometimes, strangely enough, about funky colors and seeing how that can attract clients. Now, all of these are important, and they did attract a lot of clients. But as we know, many of them ended up being a novelty and not really a main bank or even a secondary bank. So for us, it is very clear that if we want to scale in a profitable, sustainable way, the only answer is to be within an ecosystem. And if we talk about our own experience in Singapore, for context, we are a joint venture between Standard Chartered and NTUC. And NTUC is a varied conglomerate with many, many interests. Most importantly, they have the largest supermarket in Singapore and one of the largest loyalty programs in Singapore. So for us, we have embedded ourselves deeply into their ecosystem. And we are creating value propositions where the clients get tangible value by shopping in the ecosystem. And I'll give you a very small example. In the first month of our acquisition, in the first month of our operation, which was just 2 months back, we were giving clients a free bag of rice for every client who onboarded. As simple as that. The bag of rice cost $3.50. 60,000 kg of that rice was redeemed within the first month. And we know that banks spend inordinate amount of money on acquiring clients through telephones, electronics, cash gifts. But this was a very simple acquisition offer. And why it worked so well is because it is something that helps clients bring down their cost of living. It helps to moderate their cost of daily essentials. And you can imagine how our cost of acquisitions as a result will be much, much better than what it will be for other banks. I think the other point that I'll touch upon is that there is a myth, or there used to be a myth, that digital banking is for young customers. And possibly it's something that was true a few years back. Our experience is very different. In fact, one of the recent studies in Singapore show that in the last 2 years, because of the pandemic, over 80% of clients who are above 60 years old have used digital banking services. And our own experience in the last 2 months is above 10% of our client base are clients who are above 65 years old. So you can see how we have attracted a very diverse set of clients who are used to banking profitably with other institutions. And that gives us a lot of confidence of building a long-term sustainable model with them.
So, Joy, to follow up on what you said, the tie-up with, being part of the NTUC fair price system, then you managed to get, quite a lot of clients. But what about, the sustainability and getting them to make you the primary bank instead of a secondary? Or
Yeah, it's a great question. I think what's important is initially when digital banks started in other parts of the world, a lot of the focus was on deposits and payments. Now, possibly it's a good starting point, but it cannot be the ending point. And it's very clear to us that in order to be a successful digital bank, you need to have a complete suite of products available. You for sure need lending, you for sure need deposits, and you need to offer both in a very short period of time. You can't wait for a very long time to introduce your second product. So when we went to market, we were very ambitious, and we went to market with 3 products. We had a deposit, we have a credit card, we had an insurance. Of course, these are very first step, but our entire objective is that this should set us forward for lending, for more forms of wealth, for more forms of insurance, and really getting deep into the client life cycle.
yeah, and also getting them to profit-generating products. As something that you mentioned also is that digital banking back then tends to attract more young people, Gen Zs, millennials. Is that still the case now? And if so, would they be less likely to invest in, more profit-generating products?
For us, as I said, not really. Because if we look at our age distribution, it's very well distributed across the age segments. In fact, as I mentioned, over 10% of our clients are above 65 years old. To be honest, that's not something that we had initially thought would be possible. But clearly, it's very clear that the world is no longer distinguished between a digital and a non-digital. It's about which particular point in the digital curve you are in. For someone, you are entirely digital. For someone, you are still straddling between digital and physical. But for someone who is entirely physical, possibly those clients don't exist anymore. So for us, it is very clear that client adoption rates are very high. Clients are very willing to try it out. And in fact, the onus is now on us to create fantastic experiences, to create great products, and to create real tangible value, which will make the client choose us at least as their secondary bank and over time as their primary bank.
Would the rest like to share your experience with
Yeah, if I may add, I think different markets have different path to profitability strategy, right? I mean, for WeLab, we're lucky that we have 2 banks. We have one WeLab bank in Hong Kong, and we just bought one with Astra for $500 million US in Indonesia, right? So I think in a mature market, high GDP per capita like Hong Kong and Singapore, the path to profitability is not opening up bank account, but a lending product and a wealth product. I think these are differentiating digital-based products like that, right? But for a low GDP per capita, large population, that kind of markets like Indonesia, Vietnam, the strategy is a financial inclusion strategy. How do you get people to move and graduate from digital wallet to a banking account that pays interest? You can save money, you can build your life, and a credit-led strategy that has to do with a much lower unit price, ticket size, that kind of lending. So the strategy actually is slightly different for these 2 types of economies in Asia.
Sure, would you like to?
Yeah, if I can just add, I agree with everything that was said. I think the perspective I have is, so we are not yet launched our digital bank. We got our license this year, and I guess I have the benefit of actually looking across and seeing what's happened and learning from these gentlemen. I think if you think about the first-gen digital banks that started in 2015, the standard, I mean, it was very much a CASA-driven customer acquisition strategy, right? So what happens there is you push your profit curve out about 3 years. Now you have a lot of digital banks who are launching a part of consortiums where they actually embed a lot of their products into existing ecosystems. The trick of that is obviously to make that journey seamless as possible, so you end up not cross-selling but actually converting those customers seamlessly. I think the jury is out there for all of us whether we can do that. But I think the proof points have started across markets. If you look at some of the early tractions that have happened across banks that have launched in the last 12 to 18 months, I think it's quite encouraging. I think from the data that I've seen, the retention cohorts have actually been also quite encouraging. I think when you have a large number of participants launching at the same time in a given market, which is what has happened with the licenses that have been given out, there's a tendency for a gold rush to happen, competition for deposits, competition on rates, etc. But I think what is encouraging is banks have taken slightly different strategies. Yes, we have seen digital banks, for instance, pay a premium on deposits in the markets that they have launched, and I think Simon alluded to that. But I think there is a realization that your lending products, whether you're in the retail space or whether you're in the SME space, need to roll out much faster and much sooner. And I think that's also because the realization that the path to profitability is the way to win this game, as opposed to a pure tech company that depends on valuation. And I think also that's really the expectation for a lot of the regulators that have given out these licenses.
I do have to ask, though, is it difficult in a market like Singapore where we are already quite well served? And I don't know, do you feel that since you're already so well served, why, with the current banking that you can do online, why is there a need to, complicate matters or go to digital banks?
Yeah, I've been asking this question myself, that do we need another digital bank in Singapore? And I think the answer is a little nuanced. We have, to say the truth, we have great digital banking services. The fact is you can do almost everything you want digitally. But then if I asked in the room that, do you feel that in the experience that you get from your digital banking service today is almost similar to what you get from a digital native company? The answer is almost always no. There is an experience deficit which exists. And we saw some recent very strong anecdotes around it. For example, for some banks, even though you are opening the account digitally, for some strange reason, it can only be done during bank branch opening hours. So clearly, it is clear that you have put a digital wrapper on an analog process, and your backend has not been digitized. Yeah. So there are many such examples which exist, which shows that even though there is significant movement done on the digital banking services, possibly there is still an experience deficit where the digital banks can play a very strong role in. I think the other thing that I will mention is that possibly our own experience. We have launched in the last 2 months, and we have seen very enthusiastic reception for ourselves. We had over 100,000 clients who joined us in the first 10 days, and over 300,000 in the first 2 months. Now, that really shows that there is a demand in the market for a very seamless, very value-driven product, in spite of the presence of other strong digital banking services.
Apologies, gentlemen, but in my excitement to get started, I forgot to tell the audience that we are taking questions. And in fact, I've already received some. So I'd like to take this moment to have you guys answer some questions. And this is actually quite related to what we're talking about at this point. I have a question here that asks, what problems for the consumer do digital banks actually try to solve? We'll take that question first.
So maybe I can start off, and I'll request my panelists to join in. I think there are a few things which a conventional bank find very difficult to solve. Number one is we have to understand that the conventional bank's tech stack has been built over the last 30, 40 years. It's not that the conventional bank doesn't want to offer great experience. It's the tech stack sometimes holds them back from providing really real-time, user-friendly experience. For a digital bank like ourselves, we're entirely built with new tech, cloud native. We are able to offer real-time experience on every step that you do. And that's something that's very difficult for somebody else. If you look at very simple experiences, like redeeming your reward points, there are still banks around which send you their reward vouchers, which are mailed to you as a snail mail. I don't know when I last checked my letterbox. So these are small examples, small points, but each of these is a pain point for clients. And there exists significant room for improving experiences and possibly revolutionizing experiences.
If I might add to your point, right? I think what's a conventional bank? I think let me put them into two categories, right? If a conventional bank is still sending mailers, and probably I know the name bank he's mentioning, right? They're out, right? I don't think they have a right to exist, right? Now, on the other side, I do believe that there are other banks which are offering extremely well thought through experiences, are pushing the boundary on leveraging the data that they have to create personalized experiences. And I do think that these guys will be the winners. And these are the guys who've also taken the bold steps to clean up their backends, right? Moving to microservices, to the cloud. So if you are looking at investments, and if you're looking at where do you want to put your money in, I would be very, very careful of putting in money into any of those banks which have not taken, traditional banks which have not taken those drastic steps. But I will disagree with my friend here. I think for the banks, traditional banks who have taken those steps, I think the differentiation between what a digital bank is offering and what those banks are offering, I'm starting to see that narrowing massively, right? So it's a matter of, in my view, who is going to be able to push ahead faster. The digital banks need to the new banks need to learn a lot of new tricks, whereas the traditional banks who are on this path need to lose their legacy faster. So the question is, who's going to win this race? I think the jury is out there, but definitely there are going to be some losers who are not doing, traditional banks who are not going on that path.
Yeah, we've got more questions coming in, and I think there's one that is quite related to the one you're talking about, so I'm just going to put that on. They're asking, first of all, as you said, traditional banks are moving and very quickly at that. So what is the strategy of a digital bank to survive when those forces move? And if I may join it with another question so we can get more questions in. There's another question asking about how to balance between customer experience and being digital.
I think this is where it's also true to keep the nuance in mind. Over the last 5-10 years, we have also seen some sort of a demonization of traditional banks. People will say everything they do is wrong. Fintechs will come and take over the world. But what we know is actually traditional banks do many things very right. They do risk management very well. They do compliance very well. They do rigor of product management very well. And my view is that for the new age digital banks will really survive and really be profitable are the ones who combine the rigor of risk management, the rigor of traditional product management with the experience of digital. And I think that's what we have all learned over time from the successes and failures of the other digital banks around. So what is the strategy for digital bank to survive? Number one, you must have fantastic products. You must have fantastic experience. Hopefully, you will be embedded into an existing ecosystem, which gives you the right to operate at a far lower cost than what the others do. But at the same time, you must build up your muscle in cross-selling. You must build up your muscle in deepening relationships and build up your muscle to be a primary bank and not stay as a novelty.
And Dwai, following up on something that you said a little earlier, this question, doesn't operating 24/7 actually real-time also increase costs for digital banks, and do consumers need more of that?
Actually, this is where I think where the consumers are, the banks need to be there. When we launched 2 months back, we were very surprised that a lot of our clients were actually applying for our products after 12 midnight. But then when you think of ourselves, many of us are watching Netflix shows after 12 midnight. So if you're awake and you have nothing better to do, possibly you're thinking about the stuff that you didn't do in the day and you want to catch up on them. So 12 midnight to 2 in the morning was one of our highest application times. Some things we didn't expect, but something that clearly worked out. Now, if you are not available at that time, clearly you are losing out on some consumers who actually want to bank with you. So I think absolutely you need to be 24/7. And with technology that's there, there is no additional cost that you're incurring by doing that.
I'm actually interested in what you have to say. Go ahead.
So let me dial back a bit, if you don't mind, to the question on what customer problem are you solving, right?
Yeah, okay.
I think one lens to apply there is actually depends on the customer, the exact segment you are targeting. So for example, a lot of people say that digital banks are there to serve the underserved. You need to peel the onion on that one. It's not a homogeneous group, right? So I come from Malaysia, so a nasi kanda outlet that doesn't have a bank account is very different to, let's say, a food stall, right? So I think we serve a bunch of different customers in our fintech space, and sometimes it's really about solving very basic product access. Sometimes it's about solving the education aspect of it, actually getting them to understand how you can benefit from financial inclusion. And really, when it comes to customer experience, I think going forward, that's going to be hygiene. I think the space between a traditional bank and a digital bank is going to actually narrow. So, and if I'm just going to address a little bit on this point on the cost, right? I think a lot of people think that digital banks have a cost advantage, and I think that can be a misnomer because the acquisition cost and the technology cost do tend to go out of whack if you look at their experiences versus a lot of traditional banks. So while the cost-to-income ratios of traditional banks are over 50%, right, or closer to, 70% in some cases, I think over the life cycle of digital banks, it's going to be interesting to see where the highest ROE is going to be. And I think that's important to take into account.
I think I want to just add something, I think, on the earlier questions about like how can digital banks win, right? It's not going to be user experience, I'll tell you that now, because like traditional banks have fantastic user experience. But I think it's being able to offer innovative products, right? For example, I mean, what we do in Hong Kong, one of the things we do in Hong Kong, right? We're partnered with Apple. Apple has Apple Card with Goldman Sachs in the US. In Hong Kong, they have a subscription service for their products. It's powered by us. So basically allow people to get to Apple subscriptions through a subscription service, enjoy iPhone 14 at around $20 a month. And then Apple will buy back your phone by the end of the 2-year upgrade cycle. But the requirement for that to happen is when they walk into an authorized reseller, whoever is servicing it has the ability to instantly do fraud detection, KYC, risk management on the spot. That's the Apple Store experience, right? So we're able to deliver that. I think being able to lead with the technology allow us to be able to deliver this. And they actually went to all the banks in Hong Kong, and they chose us because we could do that. The second thing we did was we launched with Allianz a digital wealth advisory service. We're the first digital bank in Asia to launch a digital wealth advisory. Traditionally, banks advise with people, calling them, clients one by one, and that is expensive. But we're able to deliver a goal-based investment experience completely online and self-service.
Yeah. And adding on to that, right, I think the innovation, there comes in many ways, right? One is if you say that you reduce the entry barriers, right? I mean, traditionally, private banks and premier kind of banking kind of services are not available to the masses. And specifically where I'm coming from right now in Vietnam, right, I think on the wealth side, I'm not actually fighting anyone else. I'm fighting non-consumption, right? So the way to deal with it digitally is I think we are offering fund sales at 10,000 VND. That's 0.5 cents, right? So I think the way to engage at a lower cost, I think the conversations you can have with the customers at a lower cost, I think is absolutely critical. So the way we are selling the funds is not by saying, get into investments because we'll scare people away, right? What we are saying is, hey, you're saving for a pink Vespa, right? And this is exactly what people are saving for. Get it faster, right? Put it into some other instruments and gradually educating them and moving them forward. So that's one kind of innovation which has been promised by digital banks. I think you are seeing that come to life in many ways. I think beyond that, I think the connectivity, when you're talking specifically on the SME side kind of things, I think there are a lot of other products which are possible by leveraging the digital data, the APIs, connections with the corporates to offer a lot more products. So whether neobank or a traditional bank, I think if you are doing those things digitally, your ability to gather that data and to either lend or serve the customers better is critical and will be the winning factor.
On products, I'd like to pose this question to you guys. It came from the audience member as well. In terms of differentiation, are there genuine product differentiation when everyone is distributing the same insurance or the same funds from the same manufacturers? And I'd like to join this with another question, which is that what products as a digital bank do you see now or in the future that will be the main driver of revenue?
All right, so let me start off and please join in. I think for us, we are convinced that financial products, as you say yourself, is undifferentiated. So how do we differentiate there? And that's why we are convinced that being embedded into an ecosystem where we can create real tangible value is very important. So if I give you some tangible examples on how we are trying to do that, we are embedded into the Fair Price, which is a very large supermarket in Singapore, in their ecosystem. Everything that you purchase at Fair Price, you get back in the form of rebates on your digital bank product. But not just that, it's not just what you purchase, it's everything that you do in that ecosystem. They also operate a coffee shop, they have a large insurer, and many other interests. And we are trying to see that, in fact, that Fair Price ecosystem serves 1 million client interactions every day. That's like 20% of Singapore every day. So we are trying to see how do we embed ourselves in each of these client interactions. So if you are comparing just can you create a savings account which is going to be fantastically different from a savings account that another bank is offering, possibly difficult. But if you are embedded into that ecosystem and offering back tangible, real benefits to the client, it's extremely difficult for somebody else to compete with that.
If I can just add to that, I agree with what Dai said, but I think banks need to take it one step further. I keep saying that embedded finance needs to become almost invisible finance, right? So you need to completely remove the friction out of the process. So we deal with a lot of underserved customers, small merchants, where typically they are not digitally savvy. So any friction that you add to their existing transaction cycles makes it very, very difficult in terms of adoption. So what we find is that if you take especially in that sector, changing their behavior is very, very difficult to do. So you really need to interject into what a merchant does. Let me take one example. We do supply chain financing to small merchants in Malaysia. And we tried multiple iterations of this, but the one that really works today is, let's say if a merchant wants to order, let's say, a carton of milk, or from his suppliers a carton of milk, typically what they do is it's a cash and carry model where they pay for cash. Now we have API'd our lending into their order management system where the lending is just one toggle away, right? So the merchant does exactly what they do on a daily basis. They haven't changed their behavior. He doesn't sit in a different place. He doesn't look at a different app. But the service is actually almost invisible to the merchant. And I think I've seen a lot of embedded products out there. I think the embedding really needs to go to a higher standard to achieve mass scale adoption.
If I may add, and with all due respect, I mean, but it's just a view that we observe, right? Embedding into an ecosystem, not saying yours, okay, generally speaking, embedded into an ecosystem does not lead to profitability. It only leads to lower cost of acquisition. We've seen across the board that at the end of the day, because financial products are ubiquitous, embedding to an ecosystem actually allows you a very low cost of acquisition. But the path to profitability actually does not come from the ecosystem itself, because you need to have profitable, positive unit economics products that build on the bank for this to happen.
All right, I think we have time for one more question, and perhaps if all of you can chime in for that. So this one asks, one day the digital bank tech stack will also be outdated. So how is a digital bank thinking of hedging themselves against this? How do you stay ahead?
Hopefully that doesn't happen in the next 10 years. But there are two parts to the way the answer that I look at it. Number one, clearly we are right now building something which is really modern, really tech forward, cloud native. But what's also important to realize is we are not building everything ourselves. We are actually partnering with a lot of providers who do something very well. So somebody does device authentication very well. Somebody does fraud monitoring very well. Somebody does marketing automation very well. Instead of building all of this, we are actually partnering with them. And how that helps us, number one, is speed of execution. But number two, it hedges against exactly the risk that you're talking of. Because these guys really know how to keep themselves updated and how to build fantastic products. So for us, as a consumer of those products, we'll be always able to stay on the curve.
I think the risk is absolutely real, right? I think we are rushing ahead, building completely new tech stacks, right? Completely new ways of how those tech stacks are operating. And I think the challenge is that our engineering practices, right, the best in breed, right? And while we are expediting things, going really, really fast, is our engineering day-to-day decisions are, following the architecture that we all want them to follow. So I believe that I think all of us have the right intention to build the right microservices, the APIs, etc. But I lose my sleep then on a day-to-day operational basis, right? Is the engineering culture so strong that they are making the right decisions? And I think it's something that, having the right talent is the only way to solve, because on day-to-day those decisions are being made, which very few people are aware. So time will tell. The only way is to hire the right tech talent. Yeah.
So we like to own our own tech, and when you launch a digital bank, it's not possible to do that because you need to, you go to a vendor-driven approach, which is a bit of a paradigm shift for a technology company. And I think over time, you need to de-risk that. I think something important to call out is that a lot of vendors in this space, whether it comes to eKYC, core banking, are actually new companies, right? So a question the regulators often ask us is, what is your exit strategy? What is your vendor exit strategy? And that's a tough one to do. Typically, in our journey as a tech company, even when we start with third-party vendors, we eventually insource it because we like to own our own tech. And to the point that was mentioned, we like that agility that provides. I think, this one is something that I think the digital banks are going to have to find out as they evolve. I think there are components of that tech stack that you kind of layer up through vendors when you want to go to market that you will insource gradually. The degree to which you can do that is obviously driven by regulators, and it's also driven by the technology choices you make.
Simon.
No, nothing more intelligent to add.
Well, we've come to the end of the session. The timer is beeping there very aggressively. Thank you so much, gentlemen, for speaking with us, and we hope that we managed to answer some of the questions. I think there were some overlapping questions, so we do hope that the insights shared by our esteemed guests today are able to answer your questions. Thank you very much, guys.